Welcome to this comprehensive guide on the break-even point, or BEP. This video is designed for finance professionals and individuals alike who want to understand this critical financial concept. So what exactly is the break-even point? It is the thin line where a business's total cost meets its total revenue. At this point, the business is neither making a profit nor incurring a loss. The break-even point is built upon three core financial components: fixed costs, variable costs, and total revenue. Fixed costs, like rent and salaries, remain constant regardless of production volume. Variable costs, such as raw materials, fluctuate with production levels. Total revenue is the total money earned from selling goods or services. The break-even point has two key mathematical foundations: BEP in units and BEP in sales value. These formulas help determine the required sales quantity or total revenue needed to cover all costs. For bankers and lenders, the break-even point is a primary indicator of creditworthiness and operational risk. It is used in loan appraisal, sensitivity analysis, and ensuring business viability before committing capital. For financial advisors and insurance agents, BEP defines sales targets and commission benchmarks. It helps in assessing when a client relationship becomes profitable and how long it takes for an investment to break even. In personal finance, the BEP concept is useful for budgeting. It helps with expense coverage, calculating the rent versus buy break-even year, investment payback periods, and assessing debt refinancing options. Visually, the break-even point is the intersection of the total cost line, shown in red, and the total revenue line, shown in green, on a simple graph. The margin of safety is a crucial cushion. It indicates how much sales can drop before a loss occurs. A 20% minimum is often recommended, reflecting greater financial stability. This table illustrates how different expense categories are classified as either fixed or variable, spanning real estate, personnel, production, and personal finance. In a practical example, consider a coffee shop with $5,000 in fixed costs. Selling a cup for $5 with a $1 variable cost means they must sell 1,250 cups monthly to break even.